Today, I'm going to share the mistakes I personally made when I started investing 15 years ago. I'll tell you about my journey from new to experienced investor. We'll talk about buying and selling single stocks, investing in index funds, Roth IRA, 401k, and much more. And if you want a deeper dive in any of the topics, I made you a beginner investor guide that you can download for free, and the link will be in the description of the video. If you're new here, welcome. I'm Anastasia, and I started this channel to show strategies I use to build my own capital from scratch so that you can do it too. Let's get into it. Mistake number one was reacting to a market dip. When I first started investing, it was during my years of getting my finance MBA, and I was really into individual stocks. So the mistake I made was selling Apple stock in December 2018 during a 10% market dip that was making headlines at the time. The thing you realize later is that media makes everything into a breaking news story, which then causes even more volatility in the market. Markets and the economy is not the same thing. Markets are highly emotional and reactive, while the economy moves slowly and operates on standard set of metrics like GDP, unemployment rates, interest rates, which hardly move more than once a year. So if you zoom out and look at a longer period of time, that dip was so small and insignificant, it doesn't even stand out on the graph. For reference, here's the 2008 recession and here's the COVID recession. Both major events, and after both, market recovered and kept trending up. So if I held on to my stock back then, I would have made over 6 times my initial investment today. And here's what happened to me after I sold. Once I saw that the stock price recovered and started climbing back up, I started waiting for it to come down again so that I can invest my money again. Yet it just kept going higher and higher. And the same thing was happening with the broad market funds like S&P 500. It was getting steady returns, and it felt like the best time to buy was always in the past. So this taught me another valuable lesson that frankly I knew. It just didn't click until then. Unless you sell and make the loss final, your capital still has a chance to recover and keep earning. Mistake number 2 was waiting for the right time. This is about trying to time the market to buy and to sell. When I first started, the way I invested was I would save up a lump sum, like $1,000 or $3,000, and then wait for the market dip to invest it in. I was doing a ton of research into the best quarter of the year to enter the market, or the best time to sell, or when the companies have their earnings reports. And my brain was full of information that seemed important at the time and something I don't ever pay attention to anymore. The truth is, I never got in during the dip, and my savings were just sitting there in my savings account earning nothing, while I could have invested and started earning 8 to 10% earlier. Outside of compounding, which is when returns you earn on your investments start earning their own returns, there is another very good reason to start early and keep your money through the downturns. There is this study of S&P 500 returns over the past 30 years, and it shows that if you stay invested the entire time, your rate of return would be 8.8%. If you took your money out for any reason and missed 10 best days during those 30 years of investing, your rate of return dropped to 5.9%. If you missed 20 best days, your rate of return is 4.1%. And if you missed 30 best days, it's down to 2.5%. Best days come unexpectedly, so if you're not in the market, you'll miss them. So instead of saving a lump sum, I switched to putting that monthly amount straight into my investments, and it helped me take the pressure off deciding when to buy and sell and allowed me to stay invested longer. The next mistake was investing in things I didn't fully understand. So this applies to individual companies and all those fancy investment products that promise high returns. It's human nature to look for shortcuts, and I, like anyone else, wanted to find that one investment that would make me rich overnight. So early on, I thought it would be a good idea to buy a handful of penny R&D stocks. These were small companies that promised some kind of medical miracle or technology breakthrough. These companies are very speculative. If their research and development leads to a successful product, the stock price could skyrocket and make you rich overnight. But most of the times, these companies struggle with financing. They don't actually successfully bring their ideas to market, and they just tend to fizzle out. If you read through their earnings reports, you'll see that a lot of these companies don't have revenue and rely on venture capital or future fundraising just to pay the bills. So investing in R&D stocks meant that I was reading through tons of earnings reports, tracking FDA approvals, staying on top of development milestones. And it was just a lot of highs and lows, a lot of time and energy spent, and honestly quite a bit of anxiety trying to figure out if you're making the right decisions. So I did make a decent profit on one of the companies, but the rest really never panned out. And honestly, I did not enjoy the process. It was a lot of work. It was a lot of micromanaging and tracking every little update. So in the end, this is not where I wanted to spend my energy, and it wasn't the strategy for me. And if you're just starting out, what I would recommend is to stick to easy, proven investment options like index funds, which is essentially part ownership of many companies that you already are familiar with. A good rule of thumb is that if you can't clearly explain how a company makes money or what could make it lose money, you probably shouldn't own it. Just because something exists is not a good reason to own it. Mistake number 4 is making your investment setup more complicated than it needs to be. It's easy to think that more funds and more accounts mean better diversification. But in reality, what it does, it creates overlap and confusion. You might have the same stocks showing up across multiple funds, and those funds spread across different accounts makes reporting very complicated. And this is exactly what happened to me. In my effort to build a perfect portfolio, I kept on adding more and more funds thinking that I was diversifying. But what I didn't realize is that a lot of these funds held the same stocks, creating a ton of overlap in my portfolio. So I was basically just holding multiple versions of the same thing. Eventually, I simplified everything down to a few solid diversified index funds, and this made it much easier to track and manage performance. Same goes for the accounts. Don't open an account unless you know exactly what role it will play in your strategy. If your employer offers a 401k match, definitely go for that and roll over your old 401ks into your current one to make it easier to track. If your 401k options have higher expense ratios, or if you're maxing out your 401k and want to invest more, open an individual IRA or a Roth IRA and invest there. And if you want flexibility and the ability to take your money anytime without penalties, open an individual brokerage account. It doesn't offer tax advantage, but gives you that ability to take your money out anytime. Mistake number 5 was contributing to a Roth IRA without fully understanding the rules. Roth IRA is probably everyone's favorite account to have and to talk about. Typically, the way investments work is that you invest $1,000 and hypothetically, 30 years later becomes $3,000. You'll be paying taxes on the gains on the $2,000, either at an income tax rate or capital gains rate. Well, the way Roth IRA is different is that you pay taxes on that first $1,000 that you invest, and you don't pay any more taxes on anything else. So if you're investing in a Roth IRA and maxing it out at $7,000 a year, after you pay taxes on about $230,000 at the end of 30 years, you'll have $1 million where $700,000 is tax-free. So you can see that it's natural for people to get kind of obsessed, and I did too. But like any tax advantaged account, Roth comes with some rules that you have to know upfront to avoid getting fined by the government. I'm laying those out in details in the guide, but to give you a high-level perspective, you need to be aware of the contribution limits and income limits. The mistake I made was contributing directly to a Roth IRA after my income exceeded the limit. What happens in that situation is that IRS gives you a 6% fine. So if we assume typical returns at 8% minus 2% inflation minus 6% fine, your returns are pretty much gone. And it's actually your responsibility to know the rules so that you avoid the fines. This is also explained in detail in my free guide, so be sure to download it after watching this video. Mistake number 6 was actually letting the whole process intimidate me. As a new investor, unexperienced investor, when I first logged into Vanguard, I was so scared that I thought I could lose money just by being on the website. The terminology seemed very complicated and the whole experience was uncomfortable. Looking back, I wish I had a better perspective that doing something for the very first time is always scary and uncomfortable. And when there's a chance that you could lose your hard-earned money, panic is very, very easy to fall into. So it took me a couple of weeks just to click around, compare different funds, read what it said, and get more comfortable. And then when I finally bought my first fund with a $3,000 minimum investment, I thought the sky was going to fall as soon as I clicked the button, but it didn't. And over time, it got a lot easier. And now, even though I've been investing for over a decade, I still feel a little bit scared every time I make a transaction, and that's okay. The key is once you set it up, you don't have to make very many transactions. The less you mess with it, the more it works for you. So if you're a new investor and feel intimidated like I did, make sure to give yourself a couple of weeks to get familiar, click around the website, and work up the courage to make that first investment. Just remind yourself that doing something for the first time is often scary and that it will get easier with time. And mistake number 7 is something that happens more often than you would think: forgetting to actually invest your cash. When I first set up my Roth IRA, I had set up automated transfers sending money into my Vanguard settlement account, but I never actually selected a fund. My money was just sitting there. This is a very easy mistake to make, especially if you're new. It's very common to confuse the account with the fund. Opening a Roth IRA or a brokerage account doesn't automatically invest your money. You still have to pick a fund to put it into. And I'll tell you this, you get to decide which fund to buy. But what I'm seeing with my portfolio is that my target retirement fund that I have not touched in years is performing better than the portfolio I picked myself, whether it's leveraging funds that pay dividends, specific niche or sector. You can pick a target retirement fund even if your money is not in your retirement account, because remember that the account type is what dictates when you'll be able to withdraw your money and whether or not you get tax benefits. And the fund itself is what determines which companies you own and how your money grows. I included some additional information in the guide to help you avoid this mistake, so don't forget to download it at the end of the video. And that's what I wanted to share with you today. I hope that this is helpful. Please let me know in the comments if you've made any of these mistakes in the past, or if you've made others that would be helpful to share with this community. Thank you so much for watching. I'll see you next week.